My dear students, you have already learned the MAT provision, that is minimum alternate tax, and its applicability. Here we will calculate the book profit. In this module I am going to discuss the mechanism of tax credit also when the tax liability is paid under the MAT provision. It is already discussed in the previous lecture that it is compulsory to calculate the tax liability under normal provision and MAT provision, because 115 JB is applicable to all types of companies. So, every company is compulsory to calculate the tax liability under normal provision and under MAT provision. Under MAT provision, you have come to know that we have the tax base is the book profit. In this lecture, I am going to calculate the book profit. How do you calculate the book profit? Here, in the table, you can see the starting point is the profit as per statement of profit and loss. So, you have to consider the amount of profit which is shown in the statement of profit and loss. You have to add certain amounts if debited to the profit and loss statement, that is income tax paid or payable and provision therefore, amount carried to any reserve, amount set aside to provisions for future liabilities, provision for losses of subsidiary companies, dividend paid or proposed, expenditure relatable to any income to which section 10, 11 and 12 applies. Then you have to add the amount of depreciation, we will discuss later on that item, amount of deferred tax and provision therefore, amount set aside as provision for diminution in the value of assets, and lastly you have to add the amount standing in the revaluation reserve relating to revalued asset on the retirement or disposal of such assets. So, you have to add these items which are debited to the profit and loss account or statement of profit and loss. Then you have to deduct certain items like amount withdrawn from reserve or provision if credited to the statement of profit and loss, income exempt from tax, depreciation other than revaluation of assets debited to the statement of profit and loss. That is the depreciation we have added back which was debited to statement of profit and loss. Now, we are deducting the depreciation, that amount of depreciation not including the revaluation of assets which arises due to revaluation of assets should be excluded. Then you have to deduct the amount withdrawn from revaluation reserve which is credited to the statement of profit and loss provided it does not exceed the amount of depreciation on account of revaluation reserve. So, you have to keep in mind that revaluation of reserve is there any or not. Then the amount of loss brought forward or unabsorbed depreciation whichever is less as per the books of accounts. Now, we have to keep in mind that two items, the amount of loss and unabsorbed depreciation. The amount of loss, you have to consider only the amount of loss before depreciation. If there is no amount in amount of loss, then nothing to be deducted, because the amount of loss or unabsorbed depreciation whichever is less, if one amount is absent there, the nil will qualify for deduction. So, you have to keep in mind whether there are two balances or not. One is amount of loss which has been calculated before charging depreciation, and the unabsorbed depreciation whichever is less will be deducted, and then you have to deduct the profit if there is any profit of SIC industrial unit and the amount of deferred taxes if credited to the statement of profit and loss. So, this is the mechanism of calculating the book profit. In this way, you have to reach the amount of book profit. It's okay, it's fine. You have calculated the book profit. You have with your hand the amount of book profit and the taxable income as per normal provision. So, apply the tax rate as per normal provision and apply the MAT rate as per MAT provision. So, you have two figures, the tax liability under normal provision and tax liability under MAT provision. In case of MAT provision, we have started from book profit, and in case of normal provision, we have started the total income or taxable income. So, you have derived the amount of tax liability. Now, you have to compare these two items which we have already discussed. The higher of the two will be the tax liability for the particular previous year or assessment year. If the tax liability under normal provision is higher, the company will pay the tax as per normal provision, nothing harm is there. But in some cases, if the tax liability under normal MAT provision is higher than that of normal provision, what will happen? As per provision of 115 JB, the company is to pay the tax liability under MAT provision because it is higher than that of the tax liability computed under normal provision. So, company is to pay the tax liability under MAT, nothing harm. But the company is paying the higher tax, higher than that of the normal tax liability. In this case, the income tax authority has provided an advantage, a benefit to such companies. If the MAT is payable in a particular previous year, the company will be entitled to a MAT credit, a tax credit. What is tax credit? The tax credit means the difference between the tax liability under normal MAT provision and the tax liability under normal provision. So, you have to compare. If the MAT liability is paid, then the company will get or will entitle a tax credit, which is equivalent to the difference between the tax liability under MAT provision and tax liability under normal provision. This tax credit can be carried forward up to 15th assessment year from the assessment year in which it first comes into picture. So, the companies are availing the benefit of tax credit, and this tax credit can be set off against the tax liability in a year in which the tax liability under normal provision is higher than the tax liability under MAT provision. It is very clear concept. So, first you have to calculate the tax liability under normal provision and tax liability under MAT provision. If normal provision is paid, it is okay, no problem. But if the tax liability under MAT provision is paid, the company will entitle a tax credit equivalent to the difference between the tax liability under MAT provision which is being paid by the company and the normal tax liability. This tax credit can be carried forward up to 15th assessment year, and this carried forward amount can be set off in a particular previous year if the normal tax liability is higher than that of MAT, that is the tax liability computed under MAT provision. So, this is the facility the company is getting for paying the extra amount of tax in terms of MAT liability. So, this is the mechanism of MAT credit as per section 115JAA. As per provision of section 115JAA, the companies who are paying the liability under MAT provision, they can avail the benefit of carry forward and set up of MAT credit under section 115JAA, and such type of tax credit can be carried forward up to 15th year. Let us take an example. Suppose the tax liability under normal provision comes rupees 13 lakhs and tax liability under MAT provision comes 15 lakhs for the assessment year 2018-19. So, as per provision, the company is to pay rupees 15 lakhs because it is higher, the tax liability under MAT provision is higher than that of normal provision. So, the company is compulsorily to pay rupees 15 lakhs for the assessment year 2018-19. It is clearly mentioned in the section 115JB. But company is paying higher tax higher than that of the normal tax liability. How much it is paying? Is 15 lakhs, but normal tax becomes rupees 13 lakhs. So, the company is paying 2 lakhs more than the normal tax liability. Here, the company is entitled to a tax credit under section 115GAAA. What would be the tax credit? Rupees 2 lakhs. And this rupees 2 lakhs, that is the MAT credit, will be carried forward up to 15th assessment year, that is 2033 to 34. But this amount of tax credit can be set off against the tax liability in the particular year, in which year the normal tax is higher than the MAT liability. So, this is all about the mechanism of tax credit. In subsequent cases, we will take the case studies on these provisions. Hope you have understood the provisions of 115JB and 115JAA. Thank you.